Welcome, everyone, and I appreciate the opportunity to present to the EO family, as well as anyone else who watches this recording. I was asked to do this presentation on buyer strategies for distressed companies in the post-COVID era, and I wanted to do this because I think right now is a really unique time, and there are an awful lot of parameters that any buyer or even seller need to be very aware of. And we are in unprecedented times. And of course, that calls for unprecedented concern as far as when you make an acquisition or when you're looking to sell. So what I'm doing is a recap and a summary of some salient points for everyone to pay attention to and know that these are certain aspects of a transaction that need to be prominent in your mind as you go forward. Today, sellers are motivated. There's absolutely no doubt about that. There's several reasons they're motivated. Financial is obviously one of them. Many companies are having extremely difficult time financially. The PPP program has certainly helped, but now it's coming to the litmus test, once that runs out, what to do. Many may not realize it, but one of the bigger factors going on right now is the change in employment laws in the state of Virginia. July 1st, there were an awful lot of changes made by the General Assembly, not only to minimum wage going forward, but also to legal and lawsuits capabilities by employees that really just will make it a little bit more, will make it much more difficult to defend yourself in court, and the settlements are not a part of that equation. But really the biggest one is I think owners are tired. Enough is enough. You know, I know Leon's on the call, and he can also state that when you go into someone who's looking to sell the company, it's usually the husband and the wife. And it's usually not the husband that wants to sell the company. It's usually the wife that said it's time to sell the company. But that's not a decision they make quickly, rapidly, or non-emotionally. But right now, enough is enough. And so as a potential buyer, you know that there are certain advantages you have in the marketplace today. I will say the one advantage seems to be, this chart just came out yesterday, and I added it to the presentation quickly. But this is the average drop in valuations for deals that were actively in progress, anywhere from 24% lower to 7% lower, depending on the industry. And as you can see at the bottom, there aren't a lot of recreation events and entertainment that they would say were in progress. Does this mean that this is the precise number of a discount that you could possibly get? That answer is no. We in the industry always say a rule of thumb is only as good as your thumb. But it does give you a pretty good insight as far as what types of discounts are being looked at in deals that were started before the COVID crisis and are in the process now. I also want to say too, as far as questions, the presentation should last maybe 20 minutes, and there'll be plenty of time for questions and answers. And I do actively want people to ask questions, and will provide answers to a lot of participants. So now I think it's the time to buy. I say that with sincerity because it really is a situation unprecedented before. But normally when you talk to someone about selling a company, in reality it's 6 to 12 months. Typically confidential transaction, really you don't give them any more hope than that it can be that quick. But today's time frame, with the urgency of the slides before, that process can be more, be cut back significantly. But you as a buyer need to have your documents ready. And what documents I'm talking about is I'm talking about the documents that you personally, if you're going to be doing bank financing, you have to have 3 years of your tax returns, 3 years of your corporate tax returns, all that all ready to go. Same with the buyer. I mean, same with the seller side. You need to know what documents you need to ask for, because documentation is critical if you're going to utilize bank financing in any transaction and you want to do it quickly. Typically, the SBA loans take a minimum of 45 days. However, in the process right now, you will see later on, cutting that time frame may be critical to success and to the ability to buy it at a higher discount. Finally, the team on deck. What I'm saying by this is you should have a CPA as a buyer. You should have an transaction attorney. Doesn't mean you have to engage the CPA. Doesn't mean you have to engage the transaction attorney, but you need to have them ready. Loan officer. There's certain banks that do transactions. There's certain banks that don't. You know, if you're buying a business with a lot of hard assets, any bank will do. But if you're buying a business that has a lot of intangible value or goodwill value, you really need an SPA preferred lender. And that's a more limited list. And finally, I do think, you know, someone like myself, valuation, acquisition is good to have as part of that team. So as you're looking, you know what you need to have in place and who you're going to use in order to make an effective effort to buy quickly. The buyer's market, there's a valuation pre and a valuation post. The earlier slide indicated a little bit of that, but I think it really depends upon the performance. The other day I was looking at a restaurant that was possibly looking for sale, and you can say, gosh, it's a terrible time to sell a restaurant. But actually, if you looked at their statistics, they actually did as much business in June of 2020 as they did in June of 2019 without a bar. And what does that tell you? That tells you even with less customers and less revenue sources, that business might not lose a lot of value in this situation. Now, you don't know how COVID will act. You don't know if there'll be future shutdowns, but there are also value parts of the equation that you have to take post, meaning the COVID costs for sanitation, the higher hourly wages, legal risks, future government shutdowns, and consumer demand. But as far as consumer demand on the restaurant was, they actually were seeing a higher demand in June 2020 than in June of 2019. Whether that be sustainable or not is part of the value. The ability today to negotiate a better price, I don't think there's any better time to be able to negotiate a better price because of the unknown risk going forward. And cash versus bank financing, in a buyer's market, cash is king. And when I'm talking about cash here is not only cash from the bank financing, cash from your account, but also the possibility, the strong possibility to try to have the seller finance the acquisition. But I can tell you in the seller's world, all they really care about is getting out. The recession is here. I've had a lot of people want to buy a business, but they were concerned about, is this the time to buy it? Because, there may be a recession. I don't think there's any doubt that we're in a very strenuous economic time. But because of that, when you look at a target, the competition is less, because if that target is a sound business, their competition may be being weeded out because financially they can't sustain. The business you're looking to buy will also more than likely be very slimmed down. They've cut expenses. They probably cut staff. And so if you come in and you buy them with a more automation, social media magnitude, you may find that growth is really, really great going forward. And also because of it's a tough time, It gives you time as a buyer to integrate this new business into your business. But I would also say I call it double dipping, and you see George Costanza with Seinfeld there double dipping on the dip. The double dipping is, don't have the urge to buy something that's really not going to do you any good. You know, don't jump to buy a competitor or to buy a business without knowing that it's really going to increase your bottom line. That's one of the cautions that I think is important. If I was going to go and a seller asked me, Mr. Davis, what do you recommend? I want to sell the business fast. I would say number one, oh, and I also want to preference this because I'm not an attorney. This is not legal advice. I'm not a CPA. Okay, so I've just had a lot of experience. So these thoughts are my own. This advice is from my experience. Number one, I would tell that seller, get a bill of sale. Don't get a big legal agreement. Take a piece of paper and say, I'm selling my business. You sign it, I sign it, there's your receipt. Most attorneys in situations have said the less the seller has in writing, the better. Number two, I'd all cash. I would tell that seller, get as much cash as you can up front and get out. And number three, a stock sale. Because if you sell the stock, you're not going to have to pay back capital gains or even ordinary income on depreciable assets that you've got zero book value on that you're now getting money for. So my advice to sellers would be that. Do it simply, do it quick, and do it as a stock sale. And I think as a buyer, you need to know what that advice would be. But you as a buyer need to buy with safeguards. One of the concepts many use is an earnout. Well, if you're going to do earnout as a buyer, you want it on EBITDA. You want it after your costs. You don't want to do an earnout on revenue. If I'm advising a seller, I would only advise them to do an earnout on revenue because they can't control the costs. The second method that I've seen and used is if you want to buy a business and want to tie it, and you should tie it to a non-compete, one of the ways to do that is to tie it to a bonus, the non-compete to a bonus down the road. Again, you're deferring your purchase price, what you have to pay, but you're tying it to something. Clawback provisions are something that you really should look at, meaning that if I have a business and that business seller says, hey, look, that business is going to do great. And once COVID's over, it's going to triple. I know it's going to triple. And you should pay for that. Well, you need to use the Thomas theory. And the Thomas theory is you only pay for what you see. You only pay for what's happened. If there's going to be some arrangement for the future, then a clawback. And this is what the financial advisor example that I'm talking about means. In the financial advisor world right now, they have a book of business, and that book of business, let's say, may be $1 million. And they'll get paid $1.5 million to $2.5 million for that $1 million book of business right now, or 1.5 to 2.5 times. But they're only paid 40% up front. The remainder is paid after 18 months. They have to work in the business for the 18 months at no compensation. And if in 18 months that book of business hasn't materialized as $1 million, then they don't get the full purchase price. That's what's going on in the financial advisor world now. And that is a good example of how to hedge yourself. I would also say buying with safeguards is a business calculation. There's two types of things that I do for potential buyers, for potential sellers. I can do a business valuation, which is pretty comprehensive, or I can do a business calculation. And a business calculation is more simplified, a little faster, but really as a buyer, it gives you a pretty good understanding of what this business is worth or what it should be worth to you as a buyer. The other thing right now is the escrow, the PPP. Most businesses have done PPP, and If you're going to buy that business, know that that PPP needs to be escrowed. And the reason is, as I've always said in sales, it's not a sale to the cashes in your account. And in this situation, even though, hey, it's going to be forgiven, we know it's going to be forgiven, the government says it's going to be forgiven, until it's forgiven, it's not free and clear. And so that PPP needs to be in escrow in any transaction that's closing. The bottom line to any transaction is allocation. Allocation to you as a buyer. If you're buying, you want the hard assets as high a value as possible. If you're a seller, you want them as low as possible. So this is a tax situation and really is a key element in negotiation. And the final with safeguards is the business sale indemnification. COVID, you know, if you buy it as a stock sale, you're going to have difficulties with possible ramifications from COVID. Protecting yourself at closing as a buyer, my advice, asset sale only and selected assets only. Don't buy the stock. There is a firm called Pettit, P-E-T-T-I-T, which is out of Richmond. They do a search on your potential target and will tell you if there's any liens on that business. And this is very important. I always advise clients that you don't know who has kept a lien on your business. You may have taken out a loan for a forklift 10 years ago and have sold that forklift, and that forklift company still has a lien on all the assets of your business. Or you've had a line of credit, or you've got a loan. They file liens on the business, and until those liens are released, you can't sell the assets and you can't buy the assets. I would never buy the assets. So understand what the liens are against the business you're looking at. You need permission from the seller, but this only costs $15 to maybe $75 to get this report. The next thing in buying a target is if they have a lease, you need to understand if they have a lien waiver with the landlord. In the state of Virginia, if they lock the doors on you, whatever's inside is the property of the landlord, not of the tenant. So consequently, when they finance the sale of business, banks will ask the landlords for lien waivers so they have title to the collateral if they have to auction it. You need to know what has been done and what rights that landlord has to the property inside that you may be counting on taking elsewhere. If you're buying a target that has a lot of contracts, get those contracts novated pre-closing. You do not want the fact that you bought a landscape company with all these contracts in place, and yet 2 months after it, all the contracts are gone. When you look at financials as a buyer, you need to look at the year-end journals, general ledger. They can be write-downs for inventory. There can be magically movement of money. And you don't know what you've got unless you see underneath the skin. The general ledger journals will show that. Know how old the capital equipment is. Know how much they've invested in the past 3+ years. Know what your costs may be going forward. You protect yourself, use a lawyer. No bill of sale, meaning no bill of sale, meaning you're going to have a bill of sale, but use an asset purchase agreement. Have a lawyer put things together for you. Don't take the risk. And my advice, no liabilities. Do not take and absorb any liabilities if you don't have to. Today's SBA program is one of the best ways to buy a company right now. And so I want to give the parameters of the SBA program. As I said, most commercial lenders will only loan on hard assets. And you need to be aware of that because you may find you're surprised. I've had people who were on the board of directors of local community banks who said, oh, they'll lend me whatever I want. And when they found out it was an engineering company, they said, we don't do that kind of loan because it's all goodwill. SBA 7A loans are not the SBA 504 loans for real estate. 7A loans are prime plus 2.75 normally, 10% down, 10-year term, no prepayment penalty, meaning you could take the loan and 60 days later you could pay it all off. They will also do a line of credit to embed working capital for you. Rates now, it depends on the bank. It depends on your personal collateral. Right now, I've seen fixed at 4.25% instead of the prime plus 275, which would be about, 6 or 7% variable. Try your best to get a fixed rate. That's sort of where the market is. SBA 7A loans are cash flow based. So if you're looking at a target that doesn't have a lot of cash flow, you're not going to get SBA 7A loans. All the banks care about is getting repaid. They want to make sure there's enough debt coverage to pay the loan back. It's cash flow based. And right now, before September 27th, this may be extended, but I don't know. The first 6 months are being paid by the SBA. So your first 6 months payments, the SBA is saying, if you buy something fast, then we'll pay the first 6 months of payment for you. In summary, it's a great time to look at acquisitions. You need to be prepared in advance. Consider your hedge purchase options. What I'm talking about was the options of clawbacks, the options of earnouts, the options of seller notes. It's not the price you buy it at. It's the taxable effect. If somebody's going to offer me to buy something and the value of that equipment is higher, I can depreciate that in 3, 5, or 7 years. It's not the price. You need to understand the taxable effect, and how fast you can depreciate it is important. The other thing too is your liability firewall. Buying asset sales will be a firewall to liabilities. Hold harmless clauses, again, I'm not an attorney, are as good as the paper it's written on. You, especially in this environment, use experts at the right time. You don't need a CPA, a lawyer, business valuation day one. You need to know when you need it, and you need to know how to structure it so that your time is efficient and your costs are on target. Again, my advice, asset sale only. That's the only thing I would suggest. And the transition and the non-compete are important. Whether you need the seller or not, it's up to you, but you don't want them in 3, 5 years opening up the same business down the street that you just spent money in a pandemic environment to take out of competition for you. Bottom line, make sure you add value to your company when you're looking at an acquisition, no matter if it's today, no matter if it's a great economy, no matter if it's a poor economy. Don't get caught by the emotions of, boy, I can buy this and I can buy it for a fraction of its price. You may find out that future liabilities and future problems really make it not quite as good a deal. So this was the presentation to give a very glossy look at transactions and what the potholes and pitfalls and cautions would be, especially in the COVID environment. And I'll take my screen off share and happy to answer whatever questions that anybody has on anything.
Hey, Roland, it's Eric.
Yep.
Hey, great presentation. I learned a lot. A couple of terms I'm not familiar with. I'm sure I could Google it, but since I got you, I might as well ask. You mentioned something about allocation, and that was one. And then novate contracts. Like I'm not familiar with that. What does that mean?
Let's go novation. Typically, novation deals with government contracting.
Okay.
So I sold a company that did a lot of government contracting, and they had a huge contract with the Sea Lift Command or whatever it was. Well, they had to go and make sure that the Sea Lift Command would approve moving that contract from them to the new company. That's called novating.
Got it.
It's not something that can be automatic. Sold an advertising agency, and they had a big contract with several municipalities. They had to be novated before the transaction would even be considered to be closed. Now, the buyer didn't really understand that, but when it was told to them that, hey, we're not going to go forward with this until they're novated, he clearly understood that he could lose all that business if they rebid it, or if they just said, it's not legitimate. The other question was on
something about allocation. I forget the
okay
context, but
behind you there's a pool, and I'm sure that's a lovely pool that's not there. Okay,
sure.
But let's say you paid $100,000 for that pool. Okay, and that pool on your books now has zero book value because you did section one. That's a bad example. It's section 179, and your book value is now zero.
Okay.
When you sell that pool for $10,000, you've got to recognize that $10,000 as a seller as an ordinary income gain. So knowing that you're in the highest tax bracket in the world, you're going to pay probably 35–40% on that $10,000. Whereas if you sold that stock swimming pool as part of the company, it's on the books at zero value. There's no capital gain. There's no ordinary income gain. So allocation is an important argument, and will continue to be, because as a buyer, I want that pool at $50,000 because I can probably depreciate that off my taxes in 2 or 3 years, 4 years, 5 years. As a seller, you don't want it at $50,000 because you're probably going to face an ordinary income gain of 40% tax. That's why the price is not as important as the allocation. Does that make sense? And let's not take a swimming pool as a good example. Let's take a printing press or some business piece of equipment.
Got it. Cool. And then I know we've talked about it before, but if you come across a marketing, advertising, or media company, let me know.
I will.
I'm interested.
I got one for you, Roland, and I realize it's more of a legal question, perhaps, than a M&A guy question, and maybe our abogado who's on the call with us can jump in. So the new state laws that came out about employment law included knocking the daylights out of non-competes
Right.
for employees. Do you have any idea, or maybe our lawyer on the call does, about how, if that would affect non-competes with sellers? I mean, we want to have a non-compete, as you mentioned, that they won't come back into the industry and set up shop down the street from us. Do we think there's any weakening of that piece when we do a deal?
Oh, my opinion, and if Todd's on the call, he can certainly answer that too, and I would defer to him always as an attorney. Where I got this from is I did a transaction about 5 or 6 years ago, and I really thought it was pretty creative. And we did this with Landmark decades ago, and that was the fact that they wanted a certain price, so we tried to tie the non-compete to a bonus, so that after year 1, year 2, year 3, that they weren't going to get $100,000 each year unless if they violated the non-compete. Not only did that help allocation a little bit, but it also held them to, you're not going to compete with us. And so that's what I was talking about. As far as the laws in the state of Virginia right now, I think that's so new, but I do know that they watered it down significantly. Todd, are you on the line?
I am on the line. And yeah, so really the new law, from what I've seen, is more designed for your low-level employees that have non-competes. Those are going to be non-enforceable, but your more senior people that have non-competes, they're still going to be enforceable. So just your average run-of-the-mill employee, so there's some companies that have every employee sign a non-compete. If they're a low-level type employee, that's not going to be enforceable against them. But if you've got, a sales force and you got your top salespeople out there, that's going to be enforceable against them still.
Right, but what I think Leon is asking is that if in a seller acquisition sales agreement, if the non-compete is tied to a bonus or to payoff down the road, will that still have a chance of being legitimately enforced?
So the non-compete might not be enforceable, but what it means is you're not going to have to pay him either, like
Right.
Roland did in his transaction. So is it possible? Yeah. So you kind of now need to look at all those non-competes and the job description of the person for each of them, as well as their, the level of employee they are, to determine whether you think they're enforceable or not. Because if they're not enforceable, that's going to impact the price that you're going to give them, or you're just going to tie more of it to the payout on the non-compete as long as they comply with it. So
Right. Yeah, it would be the seller would be who'd be strings are tied. We had two brothers, and they had a big self-interest, we thought, in restarting it, let's say in 3 years. And so this was how it was formulated to stop them. Back with Landmark, if you all have heard of trading times, trading publishing, we would go out and buy the advertising rags from these people, and at a lot of money. And we didn't want them setting up a typewriter and classified publication 2-3 years down the road. So that's how we did it. We would tie that owner to that non-compete for a period of 2 to 10 years. And that would be the bulk of the sales price. So.
Roland, Robert Kinsler here. Got a quick question for you. I'm pretty familiar with the aspects of buying and selling from the perspective of getting the deal done. What I'm not totally familiar with is kind of your profession and where you fit in from a buyer's perspective. I've worked with your sort of role on being the seller of a business, and also, but not, oh geez, my head's all scrambled. I guess the question I have is, like in real estate, where a buyer will go out and get an agent to help them find a home, what does your industry do in that scenario for someone interested in buying a business? How much prospecting do you do? How much searching do you do on behalf of a client? Is it just contingency based? If you find them something, is it retainer based? How does it work if somebody's on the hunt for a business versus wanting to sell their business?
Okay, there isn't a blanket answer for that, but I'll give you the best I can. And that is, in a transaction, if I represent the buyer, obviously the commission is split between the buyer and seller brokers. Secondly, I can and have been retained to find companies for sale by potential buyers. That can either be on an hourly basis or can be on a project basis. Where most of the time that I've really been utilized, I would say aggressively in the past 3 to 6 months, as this thing started up, is that they have engaged me. They already know who the target is. They've already sort of talked to them, and they're trying to figure out a price. And they want me to look at the books. They want me to look at everything and say, what is this really worth?
Yeah.
And then more importantly, and most importantly, is can it be financed? And if it can be financed, can you figure out how to finance it? And so that's sort of the role I've been playing more often than not lately, is they already know who they're going to buy or think they know who they're going to buy, but they don't. I just did one for an Allstate agency, a guy who wanted to buy an Allstate agency. And of course, they wanted it, I think it was $2.4 million. And by looking at everything and figuring out what he had done in the past 3 or 4 years with its agency, it was only around 1.7. And of course, that just killed the sale because it wasn't worth it. But the buyer had no idea what this guy was doing behind the scenes per se. No, so that's how I've really been engaged recently, is to make sure the transaction is what it represents and make sure. Mm-hmm.
Yep, the due diligence side makes sense. What in your larger industry, whether it's been a role that you've played or not, what is the prospectus of somebody saying, hey, I want to buy a business, I don't have a target. From that starting position, what should somebody expect to get feedback from you or others that do what you do? Is that, you mentioned retainer, you mentioned project base. in the real estate market, there's nothing until the business is found. Does that
Right.
model exist at all, or is or not? I'm trying to understand. And to give it a little more context, I've got a healthy business. I've got my hands full. I have zero time to go searching, but I would be interested potentially in having opportunities brought to me. How big of a slice does that fill in your world or anyone else's in your business? Are there people who specialize in that sort of scenario, or not? Just trying to understand that better, because I'm not, I haven't been plugged into that.
Okay, I'll make a joke. I'll also let Leon answer this a little bit too. But my joke is I'm better looking than most real estate agents, and so I'm worth more. Now, to engage myself and others that are at the level I am, I charge a non-refundable retainer. And that retainer will allow me to go out and cover the costs to look for businesses in the industries and to talk to them. That retainer is applied to the commission at closing, whether or not there's a broker on the other end. So that's how that's done. I don't think you're going to necessarily find anybody worth their salt who's going to go on a search without either being paid by the hour, an hourly rate, or a non-refundable retainer in that. Leon, has been in the brokerage industry, so I'll have him shed some light on that too.
I see it the same way Roland does, and kind of the backdrop to this whole thing, when you compare residential real estate to what we do, is that you've got to have a house to live in. So it's a reasonable expectation when a Navy family is moving from San Diego to Norfolk, and they engage a broker to be their buyer broker and line up houses. Mom flies into town and gets to go see a bunch of houses, and they're going to buy something, most likely.
Sure. Yeah, no, that makes sense. That makes sense.
We're in the field we're in. There's no guarantee. Plenty of brokers have broken themselves doing a search for somebody, putting in lots of hours, and the buyer gets, there's either nothing out there that's worthwhile. The buyer, for whatever reason, there's nothing that's going to happen that meets their needs, and that broker's put in a huge amount of time. So most brokers do need to either get an hourly or a kind of a set retainer. And again, you kind of know what your hourly value is and what you've got on your plate. So that retainer is usually, you're backing what you think your hourly rate is into that.
Sure.
To do that.
Makes sense.
So
Got it.
That's how I would do it. The only way I would do it.
Can I chime in with a question up here from DC?
Sure. Yep.
Don't know if my video's on. But it looks like it is. So great presentation. Appreciate it. We've got many, like several thousand veteran-owned businesses in one of the companies I'm invested in that community. A lot of them are looking to sell their businesses. And obviously, if they're a veteran-owned business and have government contracts, it needs to be acquired by a veteran with all the same certifications to protect it. I just think with all the moving parts around COVID and PPP, and you had some really great points about escrowing the PPP cash, any other programs, there are a few special programs set aside for veterans. And whether you're a veteran or not, you're acquiring a company, or if you're a vet and you're selling your company, is there anything special that we should be aware of, or that we could get the word out to all these vets that, we literally have got tens and tens, maybe even 100 plus of these guys that are eager to sell their business. And we're having meetings and Zoom calls about that before COVID. Right. So any thoughts on that, or is it just, hey, common sense and no real changes?
I would say to you this, with my business valuation role, which I've done with a lot of the government contractors, is that when you have a business that is predominantly getting its revenue because of special exceptions, or it's veteran earns, et cetera, 8A, that type of stuff, the value of the fair market is going to be extremely less unless the buyer is in the same, would qualify the same.
Right.
So the way you preserve your value is you find buyers who are the same, just like you say, a veteran for a veteran. I think that, are there additional rules or parameters? I don't necessarily think so. I think it's the same as what I would call the vanilla marketplace. If you're a veteran and you own a business and you want to sell it, and it requires a veteran to buy it in order to survive or to thrive, then that's the niche that you'd have to go. And it's the niche that whomever's helping you would have to explore. But I don't think, everybody says to me, well, gee, my business is special. Leon is dermacare or Eric is an advertising agency. You may be a restaurant or whatever, bar. I always say, is the cash green? Is it bottom line cash flow? There's no magic to this. A buyer wants really three things. They want to know first if there's going to be enough money to pay themselves a living wage or salary. Second, the bank wants to know, is there going to be enough money to pay that loan? And the third and most important is going to be a reasonable return on investment, or should I just put my money in Dominion Power and get my 4% per year dividend? Consequently, those three factors are usually the predominant thing here. What's going on today is the perception is the SBA is making loans for business transactions, but the SBA is not a bank. The SBA is a guarantee program. The banks, banks do their underwriting, and the banks utilize the SBA program as a guarantee. So if the banks are not initiating the loans, it becomes more difficult. And that's why some of the things I pointed out about earnouts and delayed payments and all these other things are extremely valid today. But I don't think there's anything different other than if you're in a business that is, I hate to say taking advantage, but that is utilizing the contract vehicles of veteran-owned, et cetera.
Right.
You have to make sure to preserve the value for you to get your money as a seller. You've got to make sure the buyer has those, and that transition can occur. And in that, sometimes that's the stock transaction that maybe predicates a stock transaction. Doesn't have to be. That's where innovation comes in. But typically that would be the only fly in the ointment that you'd have to pay attention to.
I appreciate that. Actually, a lot of these businesses aren't on government contracts, so their status really doesn't matter. I'm wondering if there's a hidden, and I think you answered this, I think, about as well as I could have, as well as I asked the question, which is, if there's any special loan programs that vets have been taking advantage of that maybe we're not aware of. But
I'm not aware of that. If anybody here in the audience is aware of it, I know Leon's a veteran. I don't know of any that are beyond. Again, this depends also on the significance of the business. A $500,000 a year revenue business versus a $20 million revenue business.
Yeah, these are mostly small. These are mostly $2 million.
That's what I'm saying. Yeah.
This is great, Roland. I appreciate it. Thanks for having me on, guys. Roland, I may reach out to you. I think some of these vets would love to hear kind of some things you shared today.
Thank you. Anybody else with questions? We have about, Christine, I think we have about 10 more minutes, correct?
I got one for you, Roland.
Yeah.
I don't know if you've caught any of Ami Kasser's webinars. He's been pretty good about talking
Ami's great.
The Main Street lending programs that the SBA has rolled out with. And if you're seeing any use of those or people accessing those to make acquisitions, one of the things he mentioned was that even though they tend to go through a bank to service them, the SBA is not requiring a personal guarantee on those loans. So quite literally, even though they're not a 10-year term, and anybody who's watched Ami's stuff lately and remembers, help me out, but I want to say they were like 5 or 7 year terms, again, with no personal guarantee. I'm wondering if you've seen any of that activity going on or what you know about it and how you might meld it in.
No, I haven't seen that, Leon, in all honesty, at all. I think right now, most of the business targets are in financial distress or have the sellers have an awareness of something down the road that's going to catch them. So I think any type of financing may be extremely difficult once the potholes are identified. There may be people who want to make statements that they'll loan at will, but I tend to want to make sure that that would be valid. So I have not heard that or seen any of that. I do know that if it was me, and I think, Leon, you know me well enough that I've always said this to sellers, if your business is not financeable by an SBA lender, then you really shouldn't sell the business. until it is. But that guidance right now, most of these owners do not have that option because they just don't have the liquidity. They've sucked it all out with cash distributions. So consequently, they're in a forced situation. For as a buyer, that's something you can leverage and take advantage of. But I don't see in a financially distressed target that you're going to be able to get financing from a lender, personal guarantees or not. You're going to have to be imaginative and make it so that you can get your money. I mean, your purchase is going to maximize by delayed payments, incentive payments, or just a lower price.
Can I jump in for 1 second? Because Ami Kassar is in our investment group, so I talk to him at least twice a month, and he went on and on about the Main Street lending program, and it's really compelling and amazing. And he actually helped another one of our members start to go through the MSL process. And the problem is when you find the banks to loan it, they're now saying, hey, we don't even want to mess with it unless we're loaning at least $4 million. So while the program is open and sounds awesome, unless you've got that bank that's ready to rock and roll for you, or ideally a couple of them, it's kind of ephemeral.
Right.
If that helps. Yep.
Great gouge. So Roland, that comes back to the logical follow-on, which is in this kind of a market, just like we saw 10 or 11 years ago during the 2000, when 2008 came along, and I watched 4 deals evaporate as the lenders quit lending, literally in one phone call. Let's go back to owner financing and how to weave that in. You've already talked a little bit about using incentive payments after the deal in terms of non-competes and those pieces. But maybe you can share some lender or some seller financing scenarios you've seen and kind of paint the picture for those who haven't done deals before.
Seller financing most of the time for me has been combined with SBA lending. Okay. And that's where they want the seller to have skin in the game for several years. And so it used to be the SBA rules was that if the SBA bank would lend $1 million, they want the seller to take a note for $200,000. First 2 years, no payments. It can be up to 5 to 10 years at no greater and at no less interest than what the bank was charging, and secondary to the primary loan. I think right now, I'm not a real fan of seller financing as you're putting it out there, because I think there's a risk to personal wealth right now. And so I would just say an earn out and deferred bonus or just better ways to do it. I saw a business that I did a valuation for 2 months ago, and he was describing, they always argue that their value is much higher than I said. And I always say, well, I get paid to be honest. And because he had somebody 2 years ago who wanted to pay him $2 million for his business, which I just valued for $750,000. But the $2 million for his business was to be paid over 10 years, and only if certain revenue numbers, which were incredibly much higher than he had, were going to be achieved. And if you looked at what was happening in 2020 right now, he wouldn't have gotten a payment he would never gotten a payment. And so it was as worthless as it can be. But as a buyer, that's a great thing. As a seller, it looks great, but it's not reality. So seller financing can be done 3, 5, 7 years, whatever interest rate is palatable. But I would caution that if I was buying a financially distressed company or one where they were just anxious to sell and we're saying there's so much potential, I'd predicate the price on seeing the performance in 1, 2, 3, 5 years, rather than get a guarantee payment to that seller for something that erodes.
Yeah.
Does that help? Okay.
Yeah, I think so. And just to get terminology out there, you're advocating really more of an earn out than a seller note. or
Right.
some kind of blended plan for that.
Right. Or a hybrid to that, where it's based upon, if you're a buyer, you base it on EBITDA, or you base it on after your expenses.
Absolutely.
If you're a seller, you want to base that on revenue. But no, I base it on, only as a buyer, I'd only base that on EBITDA. You want to make sure it's money after your costs.
Yeah. Just making sure, does everybody understand EBITDA? Earnings before interest, taxes, depreciation, amortization. It's with a slight caveat that it assumes a general manager role, generally speaking. It's cash flow, because, right, revenue is vanity and bottom line is sanity, but cash is king, right? And that's what pays the bills. So everybody, and I know most of you know this, but again, just to make sure, your net profit is not your cash flow, because you still got the principal payments on whatever loans or leases you have that's going right off your balance sheet. It's not on your P&L. Your depreciation that's on your P&L is not really cash. It's a non-cash event. So just recognize that those two things are different.
And I'll add one aspect, unless, does someone else have a question? I can, yeah, go ahead, John.
I have a question in regards to the ratio of assets to goodwill. I recently purchased a business about 2 years ago, and because of the assets to the goodwill, it did require an SBA loan. But I also had to, it was a $250,000 purchase, and the business had to have at least $100,000 in assets. So is there like a specific ratio that they're looking at of goodwill to assets as far as the SBA loans go?
If you want honesty, what they're looking at is the collateral. What they're looking at is the collateral of the seller, of the buyer, and they're looking at the probably DNA samples of your first male-born child.
Right.
All the banks, if you have external collateral, they'll take everything they can as collateral on that loan. But yes, there were rules in the SBA that there could only be $500,000 of collateral, $500,000 of goodwill on a transaction of X percent. I think it was 20 or 25. I don't think necessarily those rules apply right now. If you have the cash flow, they obviously they've migrated a little bit. Again, that depends on the bank. A Wells Fargo might underwrite it much differently than a SunTrust or a Truist or whatever they're called these days. An Old Point might be different. A town bank, they're not going to finance goodwill. You just, that's just their bottom line.
Funny, I worked with BB&T for that transaction.
Yeah, and they're good, and they were good. What I was going to say is that, in wrapping this up, is that the other thing I do is I do business valuations, and I will say I've been extremely busy for several things. And you as business owners, number one, identifying the value of the company, not only for maybe transfers for gifts to children, or gifts or shareholder transfer, but also to understand where the value is today in this market with the finances as they are right now. So there's been a lot of work that I've done on shareholder value in partnerships and shareholder value with again, transfers of families in the past few months. And it's, you can understand the reason why. If they can transfer it at a lower value today, less taxes in the future. So.
Thank you. Thanks, everybody.
And thanks to Leon and Todd for buffering a couple of the questions. I appreciate that.
Anytime.
Mm-hmm.